This is a special podcast produced for download by Aspermont Media. I'm Paul Hunt. In this feature series, we're focusing on Canadian oil producer Saturn Oil Gas. It recently made a game-changing acquisition called Oxbow. Saturn is listed on the Toronto Stock Exchange Venture and the Frankfurt Stock Exchange. I was joined by Justin Kaufman, Senior Vice President of Exploration, to find out about the company's future drilling opportunities. Justin, welcome to the program.
Hello, thanks for having me, Paul.
You're in charge of the drilling program for Saturn Oil. It's an exciting time with the recent acquisition. What's your approach to drilling? What's the company's approach to drilling?
Yes, you're right, Paul. It's a very exciting time over here at Saturn. Saturn is currently focused on developmental drilling. With the latest acquisition that we just acquired and our previously explored Viking play, we have, as a company, over 400 book locations. These are predominantly proven locations. So there's very little risk in the development upside that goes along with them. These 400 locations equal to about 40,000 barrels of potential production gains, which is quite impactful considering our current production is around 7,000 BOE per day. To sum up, our strategy is to drill our proven drill inventory that directly offsets our previously drilled economic wells, which greatly reduces Saturn's risk portfolio and allows us to accurately grow our production base.
It's a pretty enviable position for a small company to be in. How do you manage the inventory of drilling locations?
Well, Paul, we're constantly reevaluating our booked and unbooked drill inventory. This primarily occurs through our own developmental drilling and researching the offset competitors. This constantly updated data set matched with our geological model leads us to high grade our opportunities. This decreases our risk portfolio, which allows us to drill the wells with the highest potential for production performance. This is common practice for most oil companies. We're just fortunate enough that we have such a large opportunity set to choose from.
Saskatchewan, as a province, is considered one of the most stable and favourable regions in Canada for resource development. It's also home to all of Saturn Oil's operations. Why has the company chosen to focus there?
Saskatchewan is Canada's second largest producing province. The province has a very stable government. The Sask party has been in power there over the last 15 years, so they have very stable leadership there. They also have very good incentives that encourage business growth. One of these main incentives being a royalty holiday on the first 37,000 barrels of production on a newly drilled horizontal well. So, the offsetting provinces, I'll say, they don't offer that sort of incentive. Saskatchewan also has a very favorable geology that offers stacked pay zones over multiple different basins. It also helps that most of the senior management team graduate from the University of Saskatchewan and still have a strong connections locally that help us grow our business within the province.
The company closed its landmark acquisition in June this year, the Oxbow asset. Also in your home province of Saskatchewan, how did this new asset impact your drilling program?
Well, firstly, Paul, I actually worked down on the oil drilling rigs in this very specific area in the summertime while I was going to university.
Right.
And then upon graduation, I actually started my early geological career on these assets with a company called Petrobalkan at the time. So I know the asset very well. This asset had a major impact on our drill program. Due to the increased cash flow, Saturn can now increase the amount of capital that we can deploy, which in turn will increase our reserves. While Saturn did have about 130 drill locations before we acquired this asset, we also picked up 260 book locations in the southeast. These assets are top tier locations that have been constantly ranked some of the top 10 development plays in North America. The abundance of locations has forced us to reorganize our 5-year capital plan with an abundance of extremely economic drill targets.
My guest is Justin Kaufman, Senior Vice President of Exploration at Saturn Oil Gas. Justin, the Oxbow asset that you acquired came with 6,700 barrels of oil equivalent production. How are those operations managed?
Much of our field operations team came with the acquisition of this asset. So those industry experts that have many years of experience managing those wells and facilities came over and allowed that transition to be quite seamless. They do a great job keeping production levels up and maintaining what is a very stable cash flow generating machine. My focus is deciding where to redeploy those cash flows to build shareholder value. Our current plan is to continue to grow our production base with internally funded projects, and our local operations team is more than capable of managing these operations.
What's the potential to grow Oxbow?
Well, the first step is to optimize the wells that we did acquire. So there's lots of targets for workovers, recompleting secondary zones, repairs, scab liner projects. So when oil prices went down last year because of COVID, there's a lot of wells that actually were shut in because it wasn't economic to actually put capital into those wells to maintain those production levels. So our first project is going to be going back to those wells and redeploying capital that can be made economic with today's oil prices. This is the low-hanging fruit that doesn't need extensive capital spend, but it really enhances production, and it will have very low decline with it as well.
How many non-producing wells did you acquire, and what's it going to take to bring them back into production?
Well, there's about 1,500 non-producing wells that we acquired. And where some of those wells have been produced out and declined where they are no longer economic to produce from, there was a lot of those wells that did have some mechanical failures, as mentioned before. So we've identified approximately about 400 of these locations that we think that can be brought onto economic production. This is a project that's going to take us a few years to complete, but it will increase our production levels over time. In total, we estimate about 3,500 barrels a day of oil production that we can gain from these workover targets. And this can offset natural declines in the base production to contribute to our modest growth.
What's the drilling opportunities outside of that with Oxbow?
Well, Paul, the Oxbow asset has tremendous potential for growth through the drill bit. We have a deep drilling inventory of, like I said, 260 book locations, but there's also 100 to 200 unbooked locations as well. The assets in Southeast Saskatchewan are more of a GNG developed play, geological, geophysical. And what that means is you generally need seismic to help determine where the stratigraphic edges are when developing these plays. When we acquired this asset, we actually got proprietary seismic data that covered 90% of our undrilled drill locations. So there are multiple Mississippian-aged oil-bearing target horizon zones that we can explore with this GNG data that we do have. The key light oil plays that we'll be focusing on are the Midale and Frobisher, which have been consistently ranked one of the top tier plays in all of North America over the last 10 years. These wells typically come on at anywhere between 60 and 100 barrels a day and produce about average between 50 and 70,000 barrels on a type well basis. But that being said, the top tier wells can come on 100 to 200 to 500 barrels per day and easily accumulate over 100,000 barrels of Espinal recovery through their lifetime.
Well, that brings me to, I guess, the expense or the cost of drilling these wells. What are the economics for drilling at Oxbow?
Well, the assets we acquired in the Southeast Saskatchewan, the cost of the drilling, completing, equipment, and tying in are about $920,000. That's about $100,000 to $150,000 cheaper than our Viking wells are in West Central. The little bit of discrepancy between them is that this is a conventional play. So this is a conventional carbonate formation that's highly permeable. So we do not have to frack these formations because there is that decrease in frack costs. These wells actually pay themselves off quicker than our other assets do. With the current commodity prices, we're looking at about a 6-month payout in some of our top tier wells, and sometimes cash flows equate to about 2 to 6 times the return on the initial investment. So the economics are extremely strong on this asset, and we're excited to see how they're going to drive our future growth.
What's the schedule for drilling then?
Well, we participated in two non-op wells already with one industry-leading partner, and we're just getting back initial production numbers right now. But those non-op wells were extremely successful. We are about to. We're still planning our drill program for Q4 of this year, but we plan on drilling 4 to 6 wells in Q4. All depends on the previous economics of our workover program. So we'll drill about 4 to 6 wells in the southeast, and we'll pair that with our workover program on identifying probably about 30 wells that are currently inactive that are economic to bring back online.
You've mentioned the Viking asset, and we've been talking about the Oxbow asset. Those are your two core operating areas in Saskatchewan. Where's your focus for the future? Does the Viking asset still receive attention?
Well, Saturn's lucky enough that we do have two really strong dual growth business units. So where we see the West Central Viking as a strong developmental area for Saturn. So as a lot of people in the industry know, the Viking is more of a resource play. So we have our geological model so defined that we've identified certain structural anomalies with stratigraphic overlays of thick Viking accumulation that we've proven our geological model and de-risked our future locations there. So we have 35,000 acres of net land in West Central. So we plan on continuing that development upside and continuing the success that we've seen previously with some of the strongest wells drilled in the Viking.
Justin, you've talked about how economical these Oxbow wells are. How do they compare to the Viking wells?
Well, the costs are slightly higher in the Viking, and that's because this is an unconventional reservoir. It's unconventional in the fact that you need to frack it to bring on economic amounts of oil. So the costs are approximately just over $1 million for a drill, complete, equip, and tie in. And because of that, the paybacks are slightly longer than the wells that we have in the southeast. But that being said, most of the land that we did acquire for our Viking play is crown land, which has low royalties, as opposed to a lot of the land we acquired in southeast Saskatchewan, which has a mixture of crown and freehold land. So we're lucky in that way, and we're also lucky in the way that how low the operating costs are. So in the Viking, you don't move around a lot of water. It's predominantly a 80% oil cut. So because of that, our op costs are lower and our netbacks are higher.
What are your plans for drilling at Viking?
Well, we plan on drilling 3 wells in the Viking this quarter. Our last drilling program was in Laverna, Saskatchewan. We drilled 2 3/4-mile wells there in Q4 of 2019. They are 2 of Saturn's most successful wells, and we want to continue the growth in that area. It's one of our stronger growth plays. So we plan on drilling 3 wells in this month in September of 2021 around that asset base.
Justin, I think it's important to note that last year we obviously saw the oil price crash. We've seen prices really rebound now. But what's the drilling rig market like?
Over the last 10 years or so, oil prices have seen quite the highs and lows. So back in previous to 2015, 2014, there was a lot of drilling rigs out there, a lot of different companies out there drilling many wells for many different producers. And obviously, you've seen that decline steadily since about that 2015 range. Now that oil prices have been going up, the market has shifted a bit, but it hasn't shifted to the point of the prices that we did see in that 2014, 2015 range. So a lot of these previous drilling companies that had equipment shut in and crews not working, they're just reactivating those rigs that were shut down. So there isn't really a worry about having an active drill ready to drill our wells. That's not the case, and I don't see that being the case in the near future.
Justin, we're just about out of time. Any last thoughts?
Yeah, sure, Paul. So as a geologist, love to explore, like to look for new oil and gas plays. But at Saturn, we take a conservative approach to our growth and our drilling programs. We're not looking for huge wins of discovering new fields through exploration drilling. We're much more risk adverse and focused on exploiting the oil that we have to a high degree of certainty. We believe this leads to predictable and consistent growth profile. Saturn has ideal asset base for this strategy with huge lists of internally generated projects and internally generated cash flow to fund them. In the long run, we believe this approach will yield substantial shareholder value.
Justin, thank you for your time.
Thanks, Paul.
Justin Kaufman is the Senior Vice President of Exploration at Saturn Oil and Gas. You can find out more about the company and its exciting projects at saturnoil.com. This podcast was produced by Aspermont Media.